The American dream. You need a dog, 2.5 kids, and the white picket fence surrounding your home. You're making your payments on time, slowly building that war chest, only to wake up 5 years in and realize you've been financially waterboarded by an Excel spreadsheet. How does this happen? Well, you see, what happened was the banks. They train their loan officers on exactly what to say to put your dream in motion. But more importantly, they train them on what not to say too. There are specific things about how your mortgage actually works that your bank is trained to really never bring up. Not because they're illegal, because if you understood them, you'd handle your mortgage differently and they'd make less money. So I'm going to walk you through 4 of them right now, and it's that 4th one that has cost me personally. Most people think they're saving a ton with this move, but in fact, they're getting robbed. And to see if you're getting bamboozled too, it'd be a good idea to pull up your mortgage statement, because by the time I'm done, you're going to want to check something very specific on it. Number 1, let's start with private mortgage insurance, PMI. This is a perfect example of how the game is rigged with a straight face, because PMI doesn't protect you at all. It protects the bank. If you stop paying, PMI cuts them a check. You still lose the house, you still get wrecked credit, and you still walk away with nothing. And they'll freely tell you all of that. But here's the part they won't. There is no federal law that says you personally have to pay it. What the lending industry's policy really says is if you're putting less than 20% down, somebody has to cover the bank's extra risk. The operative word being somebody. This risk, it can be sliced up in a bunch of different ways. It can be baked into a slightly higher interest rate the lender never calls insurance. It can be paid with seller credits or negotiated with a different lender. It can even be avoided altogether with a second piggyback loan. If you do end up paying PMI, here's the 3rd thing almost no banker will volunteer. By law, on most conventional loans, it has an expiration date. You can request it be canceled when you reach 20% equity, but per the Homeowners Protection Act, the lender is supposed to automatically cancel it when you hit 22% equity. But do they give you a call or send you an email saying, hey, good news, we're done charging you this extra fee now? No, not usually. They're perfectly happy to let you keep paying it until you notice and call them out on it. So if you've got your statement in front of you right now, check 2 things. 1, is there a PMI line on there? And if there is, how close are you to that 20 to 22% equity mark where, by law, they're supposed to start letting go of it? But keep this in mind, equity is subjective. If you and the bank disagree on how much equity you actually have, it may be worth you paying $300 for an appraisal versus an extra $200 a month for the next 2 years. But here's the thing when you request them to move it. Don't call, write. A phone call to a bank, it's just a legally meaningless conversation with a chatbot named Kevin who doesn't have the authority to validate parking, let alone alter your loan. Writing is the language that triggers their legal obligation to drop the fee. And if you're shopping for a new mortgage and someone says PMI is mandatory, now you know somebody has to cover the risk. But it doesn't have to be you. Next, number 2, escrow. Every month, part of your mortgage payment disappears into escrow. That's the little side account your lender uses to pay your property taxes and homeowners insurance. Sounds reasonable, sounds responsible. Here's what they don't highlight. At any given time, they're often holding $5,000, $7,000, sometimes $10,000 of your money. And in most of the country, they pay you 0 interest on it. If that same $10,000 was sitting in a high yield savings account right now earning around 4%, that's roughly $400 a year you'd be keeping instead of them. Now zoom out, multiply a few $1,000s of float by millions of mortgages, and you're talking about banks sitting on a free, non-interest bearing funding source worth real money system-wide every year. To you, it's basically a savings account that pays nothing. To them, it's a quiet 100% profit center on a cheap pot of cash they control. And surely the government is stepping in to make this fair, right? As of now, only a dozen or so states actually require lenders to pay interest on escrow balances. Federal law does not require it. In fact, at the end of 2025, the Office of the Comptroller of the Currency, the main regulator for national banks, proposed rules that would let national banks ignore those state you must pay interest on escrow laws entirely by declaring them preempted by federal law. When consumer groups and state regulators pushed back, the Bank Policy Institute, the lobbying arm for the biggest banks, filed a comment letter basically saying, look, if you make us pay interest on escrow, we'll just recover that money somewhere else by raising fees or charges on borrowers. That is the financial equivalent of a mobster in a pinstripe suit saying, nice little mortgage you got there. Be a shame if somebody added a junk fee to it. So here's the move. If your loan to value is 80% or below, you can request what's called an escrow waiver. You pay your own property taxes and insurance directly, and your money sits in your account earning 4% until those bills are due. Not everyone qualifies, so check your mortgage docs or call your servicer and ask specifically about an escrow waiver. Pay your own taxes twice a year like an adult and keep the interest for your own family. If they say no, ask them to show you where in your agreement it says you can't. And when they can't produce it, I actually put together a resource for a couple videos back that shows you where to park that money at 4% once you do get it back. Stackmybanks.com. Stop letting Chase Bank raw dog your cash for free. And look, that's just two places where banks' unwritten policies screw you. PMI and escrow. And it makes you wonder why, doesn't it? I mean, you did everything right. You got pre-approved, you found the house, you signed the papers, you've been making your payments on time for years, you've been doing everything right. And this entire time, they decided that wasn't enough. The system is stealing from you in ways nobody has ever explained. And it's not even illegal what they're doing. It's policy. And if those didn't boil your blood, wait until you see these next two. Pure, evil, greedy design. Number 3 is amortization. It's one of those words banks love because it sounds like it belongs in a textbook nobody reads. They want you to hear, for one low monthly payment, we'll let you borrow a big pile of money and pay it back over time. What they don't want you to realize is that they get paid first. Not just the first month, but the first years. Here's how it actually works. On a $400,000 30-year mortgage at around 6.5%, your principal and interest payment is roughly $2,530 a month. Sounds fair enough until you look at where the first payment goes. Month 1, the bank takes about $2,160 in interest. Only around $360 goes towards you actually owning your home. Roughly 85% to them, 15% to you. It's like buying a $2,500 ticket to a Beyonce concert, but for the first 80% of the show, you're legally required to sit in the parking lot watching roadies untangle microphone cables. You paid full price. You just didn't get the full experience until Sasha Fierce comes out for the encore. Now, fast forward 5 years, 60 payments in. You've sent well over $150,000 to the bank, but only a small slice of that has actually knocked down your principal. The rest was rent on the money. That's not just paying off a mortgage, that's a subscription fee to borrow your own house. Front-loaded so the house collects its winnings early, long before you feel like you're getting ahead. So when do you start getting ahead? I mean, if they're taking all of theirs up front, when does the majority start going toward the principal? Logic and human decency would have you think at least by the halfway mark, right? 50-50 at the midpoint? It's not even close. No human decency in this math. At today's rates, you don't hit that crossover until about year 18 or 19. The higher the rate, the worse it gets. I put together a little calculator for you so you could plug your own numbers in and then you could see where that crossover point is for you and your mortgage. Link, you'll find it in the description. But you'll see for like 2/3 of your loan, the bank takes more from every payment than you keep. You're living in the house, but financially, you're still mostly paying cover charge just to be in the building. But wait, it gets worse. And it's been a while since I've said that, but seriously, this is where it gets really twisted. Number 4, the refi. Let's say you just spent 5 brutal years fighting through the worst of the amortization curve. You've sent the bank well into 6 figures in interest. Say out of that $150,000 you've sent, $125,000 has gone to interest. You're finally getting to the point where more of each payment is starting to noticeably go to principal. And then your bank calls because the rates dipped. Hey, we can save you $200 a month. I mean, what a freaking hero the banker is. That's a whole week of groceries. Hey, sign me up, right? Well, if you do sign up, and this is the part they fail to tell you, you're smashing the reset button on that entire amortization curve. All those years of interest you already paid, essentially you're surrendering them. You're going back to day one, back to payments that are mostly interest. back to watching roadies untangle microphone cables. So if you've paid that $125,000 in interest over those first 5 years and you jump into a brand new 30-year loan just to save $200 a month, do the math there. $125,000 divided by $200, that's 625 months. That's like 52 years to break even on that trade. That's why the bank's marketing machine fires up every time rates drop. You gladly take the $200 a month savings. They happily made 6 figures. That's not a deal. That's a real business model, and you are the product. Kind of unfair, right? Well, there are a few things you can do to tilt the playing field back in your favor. One way is, if you have a mortgage rate of 4% or lower, congratulations, you captured a unicorn. Do not let it go. I'd leave it alone completely. In our current inflationary environment, that debt is actually an asset because inflation is higher than your interest rate. You essentially have a negative interest rate. Your mortgage is depreciating faster than a PT Cruiser driving off a cliff. What the bank is taking from you, the economy is giving back, and then some. Now, another way is, if you absolutely need to pull cash out of your house, do not refinance and give up that 3% rate. Look into a HELOC, a home equity line of credit. You can access your equity this way without resetting the amortization clock. I use the people at houserichcashready.com. You can check them out. Now, next, if you're hell-bent on paying off the mortgage early, I wouldn't recommend it in most cases, but if that's what you want to do, fine. Here's 2 tips. Before you make an extra payment, you must call your servicer and say these exact words. Apply this to principal only. If you don't say that, many servicers will just smile, take your money, and advance your next month's payment, which does absolutely nothing to save you on interest. It's like giving your dog a premium Wagyu steak and watching him immediately bury it in the neighbor's litter box. Principal only. Those 2 words can shave years off your loan. Second tip, if you're going to make a significant lump sum payment to your mortgage, you need to pull a move straight out of the family office playbook. And once you hear this, you're going to be furiously throw a chair through a window angry that nobody told you this sooner. Ask them to recast your loan. I know it sounds like what a theater director does when the lead actor gets a DUI, but it's actually a financial cheat code. Here's how it works. You take a lump sum, $10,000, $50,000, whatever you got, and you hand it to your lender as a principal payment. Then, for a tiny administrative fee of maybe a couple $100, they recalculate your monthly payment based on the new, lower balance. Same interest rate, same loan term, lower monthly payment. And here's the absolutely crucial detail. You do not restart the amortization clock. Why has your bank never mentioned this to you? Because they make a mountain of money when you refinance. They make practically nothing on a recast. There's no origination fee. There's no brand new loan for them to package up and sell to investors on Wall Street. The recast makes you richer. The refinance makes them richer. And that tells you everything you'll ever need to know about which option the friendly voice on the phone is going to suggest. So did you pull up your mortgage statement from earlier? If you did, you now know exactly what to look for. The PMI line, the escrow balance, and where you sit on that brutal front-loaded amortization curve. The link is in the description for that. Every single one of those is a lever that the bank prayed you would never learn to pull. They are the emergency brakes on a roller coaster specifically designed to shake the change out of your pockets while you're upside down. Your bank is not your enemy, but they are absolutely, unequivocally not your friend. They are a business, and now you know exactly how their business works. And it gets worse, because if you think the bank is making a killing off your mortgage in ways you didn't understand, inflation is doing the exact same thing with your savings. It's ruthless though. The economy doesn't send you a statement. You don't know where you stand, but it still brings the pain. And that's why I pulled this one out here for you to watch next, because the pain is optional. Here too, like your mortgage, you can tilt the table though in your favor. Even more so actually. And once you see how it works, you'll have a clear choice. Be a victim of the economy or victorious over it. Check it out and you'll see what I mean. God loves you and so do I. Take care.